Fourth quarter GDP is going to be released in less than 90 minutes. We want to talk markets ahead of that number. Ron Lagnado, who is Universa Investments Director, is here with us today. And Ron, welcome to the set.
Thank you.
Let's just talk broadly about the markets, what we've seen the beginning part of this year. We did see both the S&P 500 and the NASDAQ 100 setting record levels once again yesterday. It's been quite a tear for the markets after a little bit of a slow start where people thought, hey, maybe we're not going to see what we saw the last couple of months of the year. What do you anticipate for this year? What do you think of what you're hearing from earnings?
Well, Universa really doesn't take a position on valuation in markets. You know, our purpose is equity risk mitigation for our clients. That includes endowments, pensions, foundations, high net worth. So, you know, we're stand ready to protect against severe stock market crashes. And we found that, you know, this is an idea that goes back to Nassim Taleb, Mark Spitznagel over 20 years ago, equity tail risk hedging. So what we found is that most investors, you know, they love the equity risk premium, but they hate equity drawdown. So they tend to over-diversify their portfolio, you know, typically with bonds. 60-40 is a paradigm. You know, it's easy to sort of criticize 60-40 now in the context of what happened in 2022. But, you know, our contention is that diversifiers really don't give you a focused protection.
Go all in on equities is kind of your...
Well, we're not advocating that, but let me cite an example of pension funds. U.S. public pension funds have this funding problem. You know, the 100 largest state pension funds have about 1.3 trillion in unfunded liabilities. And my contention and my experience as I worked at CalPERS in asset allocation some years ago is that, you know, there's not taking enough risk, basically, trying to overprotect against equity drawdown. What happens with bonds as a protection against equity drawdown, a perfect example would be the global financial crisis. S&P was down 55%. Had you a 60-40 portfolio, you were down 30%. The problem is you really never monetize that protection. In fact, a lot of the protection of a 60-40 portfolio is simply you're just not invested in stocks.
So you're tricking yourself into thinking that you are protected.
You feel more comfortable, maybe you can sleep well at night, but a pension fund is really supposed to be a long-term investor with, you know, cumulative wealth maximization as an objective.
That's why Warren Buffett has said just put it all in the S&P 500.
Yeah, again, we don't advocate that. There are reasons. Investors have different horizons, different tolerances for risk, different return objectives. They may want to diversify, but tail hedging, which is what Universa specializes, actually gives you an opportunity to take advantage of drawdown. In other words, we have a strategy that pays off during severe market crashes.
How does it work?
Well, it's based on derivatives, and I know I can't really go into the details of
That's a little scary, though.
Yeah.
It's derivatives, trust me.
Well, so if you want to learn more about it, Mark Spitznagel has written 2 very interesting books on this, his sort of contrarian way of managing equity risk.
How does it work? What are your returns over time?
Safe haven and the Dow of capital.
How are your returns over time?
Well, I can't really speak directly about returns, but you know, anecdotally, you know, in 2020, Universa had very good, strong returns. Some of that information leaked out.
In 2020, but
yeah.
Over time, I guess. How does this work over time?
Well,
because it seems like you take an awful lot of risk, too.
Well, so the criticism of something like tail hedging is basically that using options to hedge risk is costly.
Or using derivatives that can blow up in your face.
The problem with that argument is that other diversifiers are even more costly. So the S&P 500 for the last 100 years has had a 10% average annual return. The 10-year Treasury is 5%. So the more treasuries you put in your portfolio, the more you're going to dilute your return.
Water down your returns.
So you're diluting your risk. You're not focusing on excising your risk. And so a tail hedge strategy is going to actually infuse your portfolio with liquidity at the time you need it the most. And with that liquidity, you can take advantage of the drawdown and opportunity to buy stocks cheaply. With ordinary diversification, the best you do is you rebalance back to target weight. And you never really, you know, in the heat of the moment, you don't know, you're not going to say, well, I'm going to move from 60-40 to 100% equity. It never actually happens. People just sit on those allocations. And in the long run, they suffer this performance drag because of this over-allocation to bonds.